Can you see me now, Irene? Okay, can you just confirm that you can see me? Great. Okay, everybody. Sorry, I did start earlier. Just some confusion about the links, so my apologies for that. So I send you very warm greetings from South Africa. The temperature outside today is around 30 degrees centigrade, and the sun is shining. And I was just very interested to see on the BBC News website that for those of you that live in Moscow, that according to that news article, there was no sunshine recorded in Moscow during the month of December, and that certain parts of Russia were extremely cold, nearly minus 50 degrees centigrade. So maybe that's all normal for you, but I certainly hope that 2018 is a good year for all of us. And Rhodes Business School is very grateful for this opportunity to have this partnership with City Business School, and we look forward to collaborating further. So just to quickly introduce myself, Owen Skay, the director of Rhodes Business School. My area of expertise is financial management. I'm the volume editor of a book that's the most widely prescribed financial management textbook in South Africa. I've taught finance for about 20 years, also in the area of governance and ethics. And this webinar is designed to build on the previous webinar that my colleague Dion Nell did, where he spoke about brands in general from an international context. And we thought that it would be very useful to talk about your bank, Sberbank, which I can't claim that I've ever set foot inside, but I was really interested to read about it and to analyze it, and then focusing on the kinds of thoughts and ideas that Dion had to see how can we bring together this study about brands and the financial management dynamics that are so important. Now, if we just go back on my own journey when I was a student back in the 1980s, then my finance professor, as did all finance professors who taught financial management in the context of a free enterprise or capitalist system, taught us that the role of the financial manager is to maximize shareholder wealth. And I guess the motivation for that was that investors into companies put their hard-earned money there in the form of buying shares, and that really the financial manager should attempt to maximize the returns to shareholders, and that is what should drive their thought processes. Then our marketing professor taught us that really it was about customer service, putting the customer at the heart of your business. But I think we had worked out ourselves even then that there was often not the right degree of conversations that were happening between the marketing people and the finance people in relation to what it really mean to be customer focused. What did this idea around profit maximization mean? And the world has moved on since then to acknowledge now, and that perhaps there are a number of companies who still have a different view, and I certainly meet a number of executives and people who hold this view that the shareholder primacy model still prevails. There's that no longer is it about shareholder wealth maximization. It's about optimizing returns, and it's really about focusing on the long-term health of the company. And so if we're going to always be chasing wealth maximization, it has unintended consequences in terms of how is it that we're going to position ourselves to be a sustainable entity? What does it mean in relation to stakeholders who may have competing demands on the company? And certainly, if you're having a financial manager who's cutting back on the pennies at the time that the marketing people need to make decisions around what is the kind of advertising spend, how do you invest in your brands, then we're not really going to be in a situation where we're going to create this the sustainable future for the company and about identifying what it means to be healthy. And so intuitively, I think that we all acknowledge, even if we're not students of business or scholars of business, that a business's success in today's modern age is a function of how well the functions of the business are integrated. So, to what extent are the marketing, the finance, the human capital, production, logistics, IT, everybody working together to achieve the mission and values and vision that have been outlined in the context of what it is that this company is setting out to achieve. And so it's on this basis that I said, let's have a look at this at your bank. And as I mentioned, I've never set foot inside there, but I was really interested to see the evolution of what it means to have transformed from, I would imagine, as a state-owned entity through to a company that now enjoys a very high prominence in terms of brand recognition, that it's doing a tremendous amount, investing a huge amount in terms of financial capital, human capital, intellectual capital, to transform itself to become a global and a world player. And and consequently, I thought, let's see from an exploratory point of view, just having a look at a particular model, which we will get up shortly, to see does the model that the two academics, Fisher and him, and that article I did ask Irene to circulate, and I hope that you all had a chance to have a look at it, the financial brand value chain, how brand investments contribute to the financial health of firms. What is that particular model telling us, and how might we apply it at a micro level, particularly within the context of an entity such as Sberbank? So what I'm going to do now is I'm just going to hopefully succeed in getting up a screenshot now that will take us through the slides. So the screen share now, just to get up the slides that if you can't read off the resolution of your screen, then hopefully you can also see it in terms of the PDF as well as the PowerPoint presentation that was sent. Now, this was originally created in Prezi. Prezi is something that I prefer to work with, but I think it was just too complicated to get it to interface with the YouTube screening. Sorry. So what the first slide shows you is the essence of the model of Fisher and him, and we'll proceed to move through those components shortly. So this is all the slides that we're going to be going through, and from time to time we'll jump to information that I obtained from the company's annual reports for 2015-2016. And then we'll go and have a look at this model, and then we'll wrap up with some kinds of conclusions. Okay, so the first slide that I wanted to present, and this is I don't have access to all of the information that is required, so we're having to often just use free information that is available. But I thought it would be interesting to just, being the finance person, let me just have a look at a little bit of the finances first. And so there's this website that you can go to, it's free, called Infront Analytics. And I find it quite useful in that you can basically identify any company, type the company in, and they present this risk profile in the form of this radar chart if you like, where we've got what they call the GPRV analysis: high growth, high profitability, low risk, and undervalued. And what they do is they then map the company that you're looking at, in this case, it would be Sberbank, against the peers, and then they apply some kind of risk score. And what they're showing here is that the risk score for them was about 6. So 6 is closer to 10 than 0, where 10 corresponds to very low risk and 0 corresponds to very high risk. And it's really, I guess, a function of saying there's an acknowledgement that the company's financial performance has been strong, that generally what we're finding is that it's operating in low risk, it's reasonable profitability. And if we look at the beta of the share, and for those of you that are not familiar with the beta is simply a measure of volatility of the share against the movement of the stock market. So generally, what we would see is that the stock market has a beta of 1. And so the best way to think about that is that if the company has a beta of 1.5, what that means is that if the stock market moves by 10%, then the company's share would move by 1.5 times as much. That would be 15%. So what we've seen over the 3 years is that Sberbank has been a relatively benign share, in the sense that it hasn't been as volatile as other shares would have been, and certainly the movement is less than what the stock market is. So in other words, over the 3-year period, if the stock market was to move by 10% in either direction, then Sberbank would have moved by 7.8%. Over the last year, we've seen it almost mirroring what is in the stock market. And so from the point of view of volatility, in terms of the view that investors have about it, I think they would probably argue that it's a safe company to invest in, but it's probably not going to generate the kinds of returns that you might expect to get out of a company like Apple Computers or Google. But having said that, this is a bank, and we certainly would not be happy to know that our bank is taking big risks in relation to what the essence of what they are. So that's risk analysis. We're relatively happy that it's in the lower risk category, and it seems to be moving in a direction that investors are happy about. Now, when we go to the next slide now, I was astounded to see, and again, I'd love to come to your country one day. Certainly, I can appreciate that looking on the map here, that you cover so many time zones. You are a huge geographical spread. The fact that you've got 15,000 branches, 117.4 million credit cards, 47.4, and so on. All of these statistics are quite mind-boggling for me. And I guess what it also shows is that the potential for this bank is enormous. And I imagine too that Russia has ambitions to strengthen its economy, to be a truly global player. And certainly, if we consider the geopolitical dynamics at the moment, the world is certainly a very, very interesting place. And I'm not here to make any comments on that, but I'm pretty sure that we can all relate to the President of the United States in terms of how the international world perhaps feels about what it is that he's trying to do or to not do, the growth of China, the growth of India, the BRICS countries. Where does Africa fit into this? And certainly I would see that the bank is positioned very well to take advantage of what might come down the line. But it also seems to me that it couldn't carry on being business as usual. And consequently, hard decisions have been made around the kinds of investments that need to be put into technology in terms of how you raise the brand profile, how is the bank going to position itself in terms of being a global player, and where are the resources going to come from in order to be able to do that. So the resolution here is not great, but I just wanted to pick up from the 2015 financial results, the main results. And certainly what we saw here was that if we look at the return on equity over the period 2011 through to 2015, there was a very much of a downward trend. The net profit went up and then it came down. And so, but it does confirm, as I said, what the GPRV analysis had shown is that the bank has shown resilience in volatile market conditions. But I suppose that that the management, the board, and as well as the shareholders are probably not happy to see this declining return on equity. So we'll touch on the 2016 results later on. Now, this, I think, it goes back to what I was talking about earlier. And I thought that this was really interesting. And I think that, again, just taking the outsider perspective, that the bank is spot on in pursuing the sustainable business model. And certainly what's also interesting and I think really innovative is this tri-modal organization of run, change, disrupt. Current activities, changes, innovation. Now, as I said, I have absolutely no idea. I've never met a person who's a customer of this bank. I've never been inside this bank. And you, based on your own experiences, may suggest something otherwise. But it really, for me, as a potential investor or an academic who's studying it, saying, yeah, I think this is the right way to go. And it's around meeting the basic financial needs. It's around getting in touch with the latest technologies. It's about engaging with your stakeholders. So from the point of view of your clients, your team, and then your shareholders, and the fact that the bank is committed to high corporate governance. And I thought that overall the annual report was actually quite transparent because you'll see that there's somewhere, I can't remember where exactly, where they acknowledged that there were weaknesses in governance and the bank was committed to sorting those things out. So already my sense is that the brand equity is being built on a proper foundation. And that this tri-modal organization around run, change, disrupt is something that we should follow with interest. Okay, now I want to come to the model as was presented by Fisher and him. And they open by saying that it was quite an interesting quote where, if you were to read the introduction, that Roberto Gozzetto, who's the former CEO of the Coca-Cola company, once noted in an interview that, what would happen if tomorrow we woke up and every single asset that Coke has was wiped out? He said, I could walk into any bank and borrow the money to restart operations just based on the strength of the Coke brand name. Now, whether that's true or not, I guess that could be debated. But the essence of what they're saying here in relation to choosing this quote is that strong brands have value. And even if the company was to collapse and that brand is strong, that counts for something. And it can count for a huge amount. And I think this is where they're really trying to say that we've got to get a much better understanding between the marketing and the financial dynamics to see, and how can we then share the common goal, I'm reading later on, to grow the value of the firm And they argue that marketing and financial objectives and the key performance indicators are therefore closely connected. And that was why I just spoke about my own journey around what did it mean in the 1980s and earlier, where it was to maximize shareholder wealth. If we consider fast forward now to this bank's context around this tri-modal organization, who the stakeholders are, and what does it mean in order to create an environment where you're customer-centric, that you're innovative, that you're achieving all the things that have been set out to do, and what does it mean in relation to how the finance people and the marketing people are working together in order to achieve that. So they then have this model, and you can read in the reading in great detail about that model. And the way that I've presented this here is to say, let's go through each of the component parts. So if we just quickly jump back to the beginning here, and really what I'm showing this section here is based on that particular model that they constructed. And the relationship shows hypothesis 1, hypothesis 2, 3, and 4. And what we're going to do now is we're going to now zoom in on these particular component parts. So let's go to the first hypothesis. Sorry. And this first hypothesis simply stated that it's good to spend money on marketing. And I suppose they use advertising as a proxy in order to do that, because I'm sure we can appreciate that from a marketing perspective, there are many components that comprise marketing, and advertising is only one component. We've got sales, we've got public relations, we've got sales promotion activities. We talk about above the line and below the line, and all of these things which are designed to create a connection between the entity and the customer. And really what you're trying to do is you're trying to create a context for them to say, hey, this is the organization that I trust, that this is the organization that I want to do business with. This is the organization that's going to satisfy my needs and wants. And particularly from a banking perspective, that whatever it is that I need from this bank, so whether I need it from a transactional banking point of view, that I have convenience, whether it's from a mortgage point of view, if I'm having to borrow money in order to buy a house or to acquire a movable asset like a motor vehicle, whatever it is, I trust them that they're going to have my best interests at heart. And so their argument here is to say, if we get this kind of expenditure right, and they've used advertising as a proxy to do that, that this will have a positive impact on what they call customer-based brand equity. So this is the CBBE, customer-based brand equity. So I then delved into the financial results to see how much did the bank spend on advertising, marketing, promotion activities. And what we saw was back in 2014 is that they spent 9.6 billion rubles, and they cut that back by 24% to 2015. So there was a reduction. And then for the period 2015 to 2016, it went up to 8.7 billion rubles, an increase of 19.2%. But overall, it's still less than what it was back in 2014. Now, there's a very famous advertising guru who lived in the United Kingdom. His name was Lord Leverhulme, and he famously once said that half the money you spent on advertising half is wasted. The problem is we don't know which half is wasted. Now, does that still hold true today? Maybe, maybe not. I think that certainly since Lord Leverhulme was around, the world has moved on a lot. And certainly we can appreciate that within the context of the social media environment, where we have all these various social media platforms, that the analytics can be quite profound. And we have to acknowledge that big data, data analytics is very much the future. And consequently, what I foresee here is that there's going to be even a much greater integration. There's going to be various entry points for people to come into the marketing field, whether it's from an IT perspective, from a business analysis perspective, from a finance perspective, because the smart companies are the ones that are going to really embrace this. And so I just wanted to say again, as I'm saying, I think it's too simple to just say advertising expenditure has this. And I don't think that they're saying that either. But I'm just wanting to reinforce this idea that, hey, if we want to build brand equity, we have to acknowledge that we have to spend something. And obviously, if what we're doing, some of it's going to be wasted, but it's justified on the basis that the returns will come, then it's probably stands to reason that this decline was not necessarily in the best interest in the bank over the long term, and consequently they've had to revisit that. Okay, now we then proceed to see that the bank has won many awards. Best personal training, best sales team, best training team, best contact center, manager of the year, banker awards in 2000, best in mobile banking, best bank in the Russian private banking segment. It won the distribution marketing innovation award. So this doesn't happen by accident. It's not something that you can just kind of say, well, let's just do this stuff. It requires investment. It requires dedication. It requires understanding the relationship between what it means to have delighted customers. What does it mean to have staff members and colleagues who, when they come into the organization, are excited to be there? They want to do the best that they can possibly do. And therefore, it confirms that the bank is able to tell a story, from even down to the point of view of the best practice of corporate governance. And I said, as I said earlier, the one thing that I always want to see myself from a governance point of view is that the company acknowledges where it's doing things not to the standard that need to be done. Because it's these kinds of things that get you to focus your mind. I think that people then appreciate the organization saying, hey, we can do better. We're prepared to show the good and the areas that we need to improve. And so it's clear to see that there's this commitment to do that. And therefore, how does that play itself out? So it plays itself out by saying that, yes, we would probably argue that there has been an improvement in this customer-based brand equity, which I will continue to refer to now as CBBE, which brings us to the second hypothesis now. And that second hypothesis in their model says that if we have good equity in terms of the customer-based branding aspect, then what do? We're going to create loyalty. We're going to create an environment where our people that work within the bank, we want to refer to that as the human capital, we want to refer to that as the intellectual capital. They want to work here because they regard us as the employer of choice. And so the way that this then translates itself across is to say it has a positive impact on financial resources. So the way that those financial resources then play out is that the company is able to acquire more equity and have a less or lower reliance on debt. Now, banks don't work the same as the traditional manufacturing type organization because, as you know, banks can only survive if they get deposits. So when somebody deposits money in the bank is now owes that money to that client. And then what it does is it takes those deposits and it lends them on to people who need to buy houses, motor vehicles, borrow money in order to grow other businesses and so on. So the way that we analyze the capital structure of banks is different to the way that we would analyze it in relation to other entities. But the point of the matter still is to acknowledge that banks will still have debt and they will still have equity. And what these academics argue here is to say we have the strong equity that's going to have a very positive impact on our financial resources. And the way that that happens is that it makes us much easier for us to acquire equity capital versus debt capital. It makes us attractive to equity investors, and it grows our base of intangible assets. And it's this value of intangible assets that's so important in the context of building this brand. And that means that there's going to be a reduction in the debt ratios. Now, what's interesting about this, though, is that if we look at it from the financial perspective, and this is something that we would want to think about if we were to take this further, is that equity is the most expensive form of capital because the required return from shareholders is always going to be greater than that of debt. So from that dynamic regarding the cost of your capital structure, one needs to appreciate that if you have a higher weighting of equity, then it might be that you're going to increase the cost of capital to the entity. And I haven't seen myself too much in relation to what impact that might have. But I think intuitively, what we're seeing here is that, and this is their argument, is that by having more equity, able to attract equity, you're attracting the kinds of shareholders that you want to attract. That means then that you can do more, you can grow more, you can be given the time in order to be able to do that. And what we've seen here now is that the change in the return on equity, there's been a fairly significant change. So from 2014 to 2015, the return on equity came down, as I showed earlier. And then for 2016, it shot up to 21%. And perhaps that's a function of the uniqueness. The fact that the bank is now getting a reputation for doing what it does, as was acknowledged by all those awards that it got, that now gives it the leverage, and I don't mean that in the context of financial leverage in terms of how much debt you have in relation to equity. I'm talking about leverage in terms of being attractive to equity investors, therefore being able to grow your intangible assets less reliant on debt. Okay, we then look at what is the appeal for investors. And I've highlighted a few points already. They talk about using the big data. And this is obviously critical from the point of view of the dynamics that I highlighted earlier. Number 6 by brand value among European banks and 24th among banks in the world for 2016. And that's from Brand Finance Global. And that I asked Irene to share with you. So I think we have to see again that this journey of getting to this point is an orchestrated thing. It's done with clear commitment in relation to what management are focusing on, having to build a strong management team. I found it really interesting here, collaborating with major universities around the world. There are times I wish that our own companies in South Africa took a much bolder stance on collaborating in this regard. But really what it shows here is that management are willing to learn. They want to hire employees with competencies in advanced technologies. There's a proprietary corporate university. There's this commitment to big data. It's about creating an environment for you to have this unique market position and develop this deep client knowledge. And I have to say that our South African banks, a couple of our banks in South Africa in the last 10 years have been identified as the most innovative banks in the entire world, which is a huge compliment to South Africa, and it's something that I'm really proud to say. So First National Bank were given an award as the most innovative bank in the world. There's another very innovative bank called Capitec. But are they able to compete on a global stage right now? No, because we don't have the capital in order to be able to do it. I think the kind of investment that they would need in order to develop the kind of brand equity that we're talking about here right now is probably beyond their reach. So for me, the interesting point now about Sberbank is you're number 6 by brand value. What is the ambition? Is the ambition to get to number 1 as an objective? Is it something that is not an objective, but it's something that could happen if they get all these things right? And built on high indices of client satisfaction. So this raises the question now in relation to this hypothesis too. And I think what they're arguing is that the equity has a positive impact on the financial implication, which in turn has a positive implication back. In short, does the equity lead to better financial management, or does the better financial management lead to the better equity? We need to say, is that actually a relevant argument to be talking about? I leave that for you to think about. But if we get this trajectory right, what Fish and him are saying is that you do that, you create the CBBE, you get financial resources. And it seems to me that the bank has identified this because of this specific upfront statement saying, appeal for investors, we are working to increase earnings per share by ensuring the growth of business value for our shareholders and investors. I would just want to be sure that this is not being done from the point of view of a profit maximization approach in the short term. What we're doing is we're looking at the long-term financial health of the organization. And that is critical then, that this integrated thinking and balancing between finance, marketing, all of the capitals that we speak about, intellectual, financial, manufactured, human, social capital, natural capital, are all being utilized in a responsible, sustainable way. Okay, so if we now look at their debt to equity ratio, because they then say that obviously you have this positive impact on your financial resources, what we would expect then is that the financial leverage would lessen the amount of debt. So this is where they talk about a negative impact on financial leverage. And this negative impact is actually a positive thing. Now, again, we have seen that happening here. What we've seen is that the equity multiplier has come down. So in other words, there's a lower reliance on debt now. Now, I haven't presented the DuPont ratio. And if we were in a classroom situation, I'd be asking the class now, who you are familiar with DuPont? And I wanted to try to work out the DuPont ratio, and I wasn't able to achieve it because I didn't have access to all of the numbers, but I got fairly close. And essentially the way that the DuPont ratio works, and that's the ratio that was compiled by the DuPont company in the United States decades ago. What it does, it takes your margin and it multiplies it by the asset turnover, and it multiplies it by the equity multiplier. So EM stands for equity multiplier. And what we're showing then in the DuPont ratio is that DuPont calculates your return on equity. So normally what we do to calculate return on equity is you would take your return, you would take your net profit, and you divide it into your equity. What DuPont worked out is that return on equity is a function of 3 things. And those 3 things are your profit margin, how well you turn your assets, the asset turnover, and how you finance those assets. In other words, what is the mix of debt and equity? And what we find is that by simply introducing debt into your capital structure, you can increase the return on equity. So what we're seeing here with Sberbank is that the equity multiplier, in other words, the proportion of debt to equity has come down, and the fact that they have improved their return on equity says that they've done some really good stuff in terms of the margins, and they've done some good stuff in terms of the asset turnover. Although in the bank context, the asset turnover would certainly not count for a lot, given the fact that it's a service type organization. And as I said, we can't consider the bank in the same way that we'd analyze a manufacturing. So what I'm seeing here is that they have managed to generate a great return on equity for shareholders, not by borrowing more money, but in fact by getting things in the business itself right. In other words, how the business is operating. So it seems to me so far, what's happening in Sberbank is following the model that Fish and him have spoken about. Now let's move to hypothesis number 4. And hypothesis 4 says the cost of debt. So they would argue then that because of the financial resources, because of the positive impact on the customer-based equity, your credit spread now comes down. In other words, when it comes to the bank actually going to borrow money, it has a positive impact on its credit rating. And I must admit, I was a little bit surprised to see that if we look at the Fitch and Moody's ratings, I thought that it would be better. So, you would have to, if you're not familiar with Fitch and Moody's, you'd have to just go and see. But I think Fitch, this is investment grade. Moody's is just below. So, but they see that as stable. Now, whether that's tied into country risk as well, I think that Fitch and Moody's would consider all of these things. But it seems that the bank has still got some way to go to convince the credit rating agencies that it's really up there in the AAA. And certainly what we'd want to do a proper analysis here maybe is to look at how does Sberbank compare to its the major peers in Europe, the major peers in the US, and so on. So, as I said, I was a little bit surprised. I thought it would be better than it is, but nevertheless, having said that, and one of them is still showing investment grade, and they see the outlook as stable. Then when we come to hypothesis 5 now, and this is closing the loop, they would say, okay, we have a positive impact on financial resources. What does that mean? It means that we can spend more money on our advertising and our marketing activities. And that, I think it's intuitive. Sometimes I think that academics, we don't actually complicate things. People sometimes see academics as complicating things. Intuitively, I think we see that the model is intuitively correct. You create an environment to create those connections. You build this equity that has a positive impact on your financial resources. That means that you're more attractive to equity shareholders. That means that to the providers of debt, they see that as low risk. That means that you pay lower interest. Operationally, you're more efficient. That means that you can spend more money on your marketing activities. And I think that this hypothesis 6, then they talk about it drives it beyond the ad spend itself. And this, for me, I just raised this here. Does this now take us into the qualitative realm? Are we now in the realm of Lord Leverhulme, who said half of what we spend we waste? The problem is we don't know which half. And therefore, where is the data analytics going to come into this? How is it that we're going to create an environment for the people within the organization and the integrated thinking that's required in this bank in order to drive it forward? So I just, as I said, I really enjoyed learning about the bank, looking through the annual report. And if we look at the retail clients, the main achievements in terms of what they did, 83 million clients. I mean, that's more than the entire population of South Africa. So that, for me, again, is just astounding. But probably would be quite small, maybe compared to similar banks in China. But again, the awards and ratings, the most accessible bank, the most reliable bank, best in mobile banking, positive user experience, the leader of loyalty. So what is happening now is that they're in a position to trumpet it out. They're able to stand up and say, not in an arrogant way. I don't read here that there's arrogance in this, because for me, arrogance is the demise of any organization. But hey, we've gone on this journey. We can now stand up and say that we're achieving these things. And so it seems to reinforce that Fisher and him are correct intuitively in terms of what they're saying. But having said that, there's more than intuitive evidence to suggest that this bank is moving in the right direction. I'm hoping that this is a little bit easier to read now, but what we see now is that you can see quite a big improvement in the net profit. And as I mentioned to you earlier, we would have picked that up in the DuPont ratio because we saw that the equity multiplier showed a reduction in debt. You can see a tremendous improvement in the cost to income ratio. We can see that there has been an improvement in the return on assets. So from 2.7 down to 0.9, 0.9 up to 2.1. I want to just to conclude with one slide now, but before we do that, is really to say, notwithstanding all of this, and this is the critical question, has the investment in the financial resources needed in order to drive this positive equity been the contributor to this? Or has the positive brand equity that's been created contributed to these green lines here? In other words, it goes back to the point. Is it the finance that we do first to get the brand right, or is it the brand right? Do we get the brand right first in order to get the finance, or do they become mutually reinforcing? That's the question that I leave you with. This slide now is something that my colleague Dion presented to me, and it's something he may have showed you similar to that. And all that he said to me was that what we're seeing here is that Sberbank has dropped off the global ranking. So that bank, your bank doesn't fit in, is not shown here anywhere. The company, the banks that are doing the best are Wells Fargo. So you can see how Wells Fargo is the only one that's going up. The rest are coming down. I think that's the bank in China, ICBC. And we see that Bank of America was doing something, but it's now getting lost in here. And so what Dion is suggesting is that generally the banks are on a downward trend. And therefore, what does that mean for Sberbank, for example, in relation to where its brand positioning is going to be going into the future? Probably then that would mean a good bank to do a comparison between Sberbank would be Wells Fargo. And for those of you that don't know, Warren Buffett, his company Berkshire Hathaway, is a very substantial investor into Wells Fargo. So Berkshire Hathaway is a strong investor into Apple Computers, Wells Fargo, and Heinz Kraft Company. So what does the Wells Fargo story tells us? It tells us that I think most people would argue that Warren Buffett is probably the most smartest investor in the world today. Why did he invest in Wells Fargo? Did he invest in it because of its brand equity? Did he invest in it because of its financial well-being? Maybe we need to understand that those companies understand the relationship between finance and and brands better than anybody. And certainly if we look at a company like Apple, which is in the top 3 brands in the world, if you look at the brand NZ index, Apple's there. It draws investors like Warren Buffett. So with 5 minutes to go, that's all I've had to say. Let me just, go back now to removing the screen share. And if anybody's got any questions, please feel free to ask. Okay, so I think I can see myself again there. So if any questions, I hope you found that useful. And Irene asked you. So Irene asked a question. Where do I see Sberbank in the next 10 years? I don't see any reason why it couldn't be the number 1 brand. But I'm not a political scientist, and I think, as I mentioned earlier, the geopolitics is it's complex right now. I would certainly hope, I'm not a politician, I would hope that our politicians can find a way for us to transcend our nationalities, and to create an environment for business to flourish, because it's something that the world needs, but it needs responsible business. It needs responsible business people. I'm of the view that Sberbank is authentic in what it is trying to do. And again, I cannot talk about that from a direct experience. So no doubt some of you are customers, you may have stories that would counter what I'm saying. But what I'm reading, and what I've researched, they're an authentic bank. So I see no reason why they can't carry on with that trajectory. But what Dion told me this morning, that we were discussing prior to, which was really interesting, is that he's done some research to show that when you remain regional, it does have an impact in the perception that people have about you. But when you become a global brand, then customers don't care where you are from. It means nothing to them as to whether you're a Russian bank, a American bank, a Brazilian bank, or South African bank. So if Sberbank can get back to being that international brand, then I think the sky would be the limit. Irene's second question was South African banks being world famous. As I mentioned, our First National Bank and Capitec Bank have won awards for being the most innovative banks in the world. But right now, we just don't have the capital in order to pursue these global ambitions. But at the very least, what we do know is that a lot of the international banks do come to South Africa and try to learn about what we're doing. And I really hope that Africa can become more integrated. And I think that's where Russia, China, India, Brazil have a much bigger role to play in ensuring that we break down the barriers to doing business, that we create open markets. And then I think our banks would really grow tremendously. Okay, everybody. So thank you very much. I think time is up now. So I wish you well, and I hope the weather warms up for you soon. Okay. Bye-bye.